The 5-year Treasury is currently at 4.06% and the 10-year Treasury is at 4.14%. So the 5-year Treasury is up about 10 basis points from last week and the 10-year is up about 7 basis points. And I'll get into why that is in a minute. But the biggest piece of data this week is going to be core PCE. The general consensus is that it's going to come in at 3%, which would be the lowest point since March 2021. Core PCE has been dropping about 0.2% per month since the last half of 23. So if that pace continues, that puts the Fed's preferred measure of inflation to 2.4% by the end of Q1, which would be announced after the March 20th FOMC meeting. So Friday's number and February's number will be the core PCE reports that will ultimately decide the decision in March on whether to cut or to wait another month or 2 or 3. That said, monthly inflation is already annualizing to 2% if you take a look at the charts. So anyways, the Fed did make a bunch of speeches last week to signal to the market that the chance of a rate cut in March is too early and it drove treasuries up. So that is the reason why we've seen treasuries rise over the last week. Remember, I told you it's going to be a bumpy ride. It's not a straight downhill from here. And frankly, I don't expect that the treasuries are going to drop this fast anymore. I think we had the majority of our drop over the last couple of months. So now all that Fed speak last week basically brought the odds of a rate cut in March to 50%. So it's down quite a bit. I think it was last week, it was 80%. And then it went down to 72%. So now it's down at 50%, which I think is a little bit more in line with what reality really is. There's still a chance that they'll cut in March, but likely they're probably going to wait until June. And the odds of a cut in June are 99.4%. So that means it's basically we're getting a cut in June, right? I mean, that's about as certain as the market could be. They have to leave in some possibility of them not cutting in June, but the odds are super low, basically zero at this point. So like I said, I'm projecting that the Fed's going to start cutting in June and that it'll be a 25 basis point decrease at each meeting through the end of the year, which would put the Fed funds rate around 4 to 4.25 in December. Now, I mentioned that the Treasury is up because of all those Fed speeches. It basically broke the ceiling of 4.05%. And I think it's going to be temporary because this week's inflation data should cause Treasuries to edge lower. If you look back at the last 3 cycles, once the market pivoted to cutting rates, the 10-year Treasury dropped about 150 basis points from the peak in each cycle. So we peaked at 5% in October, which means that in 2024, the 10-year Treasury should end up somewhere around 3.5%. So like I mentioned, we're currently at 4.14, so we maybe have another 64 basis points to go this year. And we've been as low as like 3.9. So this is what I'm saying when I'm saying I think that we got the majority of the Treasury drops over the last few months. And now I think we slowly decline from here, meaning that the 10-year should end up somewhere in the 3.5% range. The 5-year should end up somewhere a little bit below that. So you can do some math as long as the banks don't keep beefing up their spreads. Rates right now for multifamily are around the 6.4, maybe 6.5 because treasuries are up this week. So you can expect that rates will be somewhere around 5.75 to 6%. That is the forecast for the end of the year. And honestly, it's right in line with my bets that I placed. I said by summer that we'd be around somewhere around 5.75 to 6%. So let's hope that I'm right. That would be good. I think that would help the market get moving a little bit because it's still trying to move. But if you need financing, it's still a little bit tough. Now, obviously, outside of 12 months, the yields push much lower when we're in a market of cutting and in the cycle of cutting rates. So outside of 12 months, we should see the yields pushing much lower. But I just want to caution you in making that assumption that treasuries are going to go down at the same pace that they have over the last few months. So if you need to refi or you're planning to purchase with debt, this year in 2024, a safer assumption is that we maybe have another 50 basis point reduction based on previous data. So that's it, guys. I kept it short this week. Like I said, the core PCE data is coming out on Friday. That is the biggest piece of data, the most important piece of data that we're looking out for this week. And on Wednesday, we get GDP data as well. So you guys have a fabulous week. If you have any questions, feel free to reach out to me. I've been having a bunch of questions about bridge debt recently. So if you have any questions about that, reach out to me. I will say that I think there's still some unrealistic expectations out there based on what I've been talking to people about. Like they think there's some really cheap bridge debt out there. There is not. So I would say that the cheapest bridge debt you're getting in the market today is somewhere around 8.4% all the way up to 9.25%. So if you are buying deals and you're assuming that you need bridge debt so you can reposition the property, a safe number for underwriting and looking at what your overhead cost is going to be is to look at 8.4% to 9.25%. We can do interest only on that, but I just want you guys to be realistic about the bridge debt because it's definitely not cheaper than long-term debt, which is at like 6.5%. So anyways, have a great week, everybody, and I will see you next week.